Drained vaults. 400 million ounces claimed on paper, but only 100 million sitting in the registered pile. March delivery deadline. Approaching fast. January saw 50 million ounces demanded. February added 20 million more. The math doesn't work, and here's what almost nobody is saying out loud. The largest holders aren't rolling forward anymore. They're standing. COMEX just raised margins again. Physical premiums in Dubai hit $127 per ounce, while paper contracts trade at 73. That's a 70% gap between what's real and what's promised. The system has pressure valves, but what happens when every valve gets tested at once? March isn't just another delivery month. It's the moment the entire architecture gets stress tested in real time. Welcome to John Analyst. If you've been watching markets long enough to remember when fundamentals actually mattered, you're in the right place. This channel exists for those who prefer strategic intelligence over entertainment. If that sounds like you, consider subscribing, not because you'll agree with everything said here, but because understanding how these systems actually defend themselves is worth more than guessing. And before we go further, drop a comment below. Tell us where you're watching from today. New York, London, Singapore, Dubai. Geography matters in silver right now because the pricing disconnect between East and West is becoming impossible to ignore. February 9th, 2026. A date most people will scroll past without a second thought. But for those tracking the silver market, this is the day the numbers stopped making sense in a way that could no longer be ignored. The registered silver inventory sitting in COMEX-approved warehouses, roughly 100 million ounces. The open interest in silver futures contracts, representing claims on over 400 million ounces. 4 times the immediately available supply. That gap is not a theory. It's not a rumor. It's published data. Updated daily. Visible to anyone willing to look. And here's what makes this different from every other time someone has screamed about silver shortages. The behavior changed. January is typically a quiet month. Traders ease into the year, positions get adjusted, delivery requests stay modest. But January 2026 saw something unusual. Deliveries approached 50 million ounces. Not a small bump, not a typical fluctuation, a volume that made analysts check their screens twice. February followed with roughly 20 million more, and these weren't just numbers on a spreadsheet. These were contracts converting into claims on physical metal during months that are not even considered major delivery windows. The real test? March. March is one of the heavy delivery months on the futures calendar. It's when the system traditionally gets loud, when industrial users lock in supply, when large holders make their moves, and if the pattern from January and February continues, if that same unusually high percentage of open interest decides to stand for delivery instead of rolling forward. The system faces a simple arithmetic problem. More claims than metal, but here's where most people get confused. They think of silver trading as one unified market. One price, one reality. It's not. There are 2 distinct layers operating simultaneously, pretending to be the same thing. The first layer is physical. Real metal. Bars that weigh something. Inventory that sits in specific vaults in specific cities. Metal that requires trucks and insurance and logistics to move. This layer is finite, measurable, slow. The second layer is paper, futures contracts, derivative exposure, positions that can be created instantly with a few keystrokes. This layer is fast, expandable, built on leverage. Under normal conditions, these 2 layers coexist peacefully. The paper market provides price discovery. The physical market provides settlement when needed. But when stress enters the system, when more participants than usual decide they want the physical layer instead of the paper layer, that's when the gap becomes dangerous. And the gap right now, visible, measurable, growing. Inside the COMEX warehouse system, silver gets classified into 2 buckets. Bucket 1 is called registered. This is metal that has been specifically tagged to meet delivery obligations. It's the portion of inventory that's ready, legally and logistically, to be handed over when a contract demands it. As of early February, that number sits around 100 million ounces. Bucket 2 is called eligible. This is silver that meets all the quality standards. It sits in approved vaults, but it has not been designated for delivery. Why not? Because it's owned by someone, and that someone has not chosen to make it available. Eligible metal can be converted to registered, but it requires the owner's consent. And consent usually requires incentive. The critical question facing March is this. If demand for delivery continues at January and February levels, will eligible metal convert to registered fast enough to meet the claims? And the answer depends entirely on price, on spreads, on financing terms, on whether the owners of that eligible metal believe they'll get paid enough to release it into the deliverable pool. This is not a story about conspiracy. This is a story about inventory management under pressure. When the paper layer expands faster than the physical layer can respond, stress builds, and stress creates decisions. Who rolls their position forward? Who stands and demands metal? Who accepts a cash settlement? Who insists on taking bars out of the vault network entirely? These decisions don't happen in a vacuum. They're influenced by margin requirements, by volatility, by trust in the settlement process. And right now, every one of those factors is being tested. The system has mechanisms designed to handle stress, pressure valves, incentive structures, ways to encourage cooperation when supply gets tight. But mechanisms only work when participants believe they'll be honored. The moment belief cracks, everything accelerates. March is not just another delivery month. It's the focal point where 400 million ounces of paper claims meet 100 million ounces of registered reality, and the world watches to see which layer bends first. While everyone watches the price chart, the real story is happening in the collateral requirements, and almost nobody is paying attention. In the span of just a few weeks, COMEX has raised margin requirements on silver futures contracts multiple times. Not once, not twice, multiple times. The initial margin requirement now sits in the high teen percentage range. For those unfamiliar with how futures markets operate, that number represents the amount of capital a trader must post as collateral to hold a position. When that number goes up, positions get expensive to maintain, and expensive positions disappear. This is not a minor policy adjustment. This is the exchange deploying its most effective tool for controlling market behavior. Margins don't create physical silver. They can't magically produce bars out of thin air, but they can do something arguably more powerful. They can change who is capable of demanding delivery. Here's how it works in practice. A speculative trader holds a large silver position. They're betting on price movement. They have no interest in taking physical delivery. They simply want exposure to the price. When margins rise, that trader faces a choice: either post more cash immediately or reduce the position. Most choose to reduce. The leveraged players, the ones holding positions 5 times or 10 times their actual capital, they're the first to exit when margin pressure increases, and that's exactly the point. The exchange knows that genuine delivery demand comes from a specific type of participant: industrial users, large institutions, entities with actual storage capacity and logistics infrastructure. Retail speculators demanding delivery? Rare. Leveraged funds demanding delivery? Even rarer. The margin increases act as a filter, a way to flush out the noise and identify who is truly serious about taking metal. But there's a deeper mechanism at work here that most market observers miss entirely. The exchange doesn't set margin requirements arbitrarily. They use forward-looking volatility models. These models analyze options pricing, historical price swings, and current market stress indicators. When expected, volatility spikes, the risk models trigger automatic responses. And the response is always the same: raise collateral requirements. Why? Because the clearinghouse operates on one fundamental promise: we will not be the party that breaks. Every futures contract involves 2 parties, a buyer and a seller, but both parties are actually transacting with the clearinghouse, not with each other. The clearinghouse guarantees performance. If one side defaults, the clearinghouse steps in and makes the other side whole. But that guarantee only works if the clearinghouse has sufficient capital buffer to absorb shocks. When volatility increases, the potential size of those shocks increases. So margins rise to match. This is not manipulation. This is risk management. But risk management has consequences. And the consequence right now is that holding a silver position into March delivery has become significantly more expensive than it was 60 days ago. That cost increase changes behavior. Traders who might have considered standing for delivery suddenly find it cheaper to roll their position forward into a later month. Funds that were leveraged 4-to-1 now find themselves forced to cut exposure in half. The open interest number that looked so threatening a month ago, it's getting smaller, not because demand disappeared, but because fewer participants can afford to stay in the game. Now here's the part that connects back to the registered versus eligible distinction from part 1. If deliverable supply is genuinely constrained, if the registered pile cannot meet demand, the market has another pressure valve. It can pay for cooperation. When spreads tighten, when the nearby month trades at a premium to later months, that premium creates an economic incentive for holders of eligible metal to convert it to registered status. Think of it as the market offering a bounty. We need deliverable metal. We'll pay you more if you make yours available. Sometimes that payment shows up as higher premiums. Sometimes it shows up as favorable financing terms. Sometimes it shows up as a direct commercial arrangement negotiated behind closed doors. The point is, the system has ways to expand deliverable supply without waiting for new production. But those ways only work if the incentive is strong enough. And that's where March becomes the test. Will the premiums be sufficient to unlock eligible inventory? Will margin pressure reduce speculative demand enough to bring claims in line with available supply? Or will genuine industrial and institutional demand remain stubbornly high, forcing the system into more drastic measures? The answer determines whether March clears smoothly or whether the system reveals just how fragile the settlement process really is when stress tested at scale. Because there's one more critical distinction that needs to be understood. Delivery is not the same as withdrawal. Most delivery activity in the silver market is simply paperwork. Warehouse receipts, changing hands, ownership transfers within the approved vault network. The metal never leaves the building. This is how the system can report massive delivery months, while total vault inventory barely moves. But withdrawal? That's different. Withdrawal means metal exits the vault network entirely. Someone demands their bars, loads them onto a truck, and removes them from the system. That's the signal that matters. Because as long as metal stays inside the network, the clearinghouse can keep playing musical chairs. Registered becomes eligible. Eligible becomes registered. Ownership shifts. But the total pool remains stable. It's when metal leaves, when trust in the warehouse system breaks, that the architecture comes under real threat. And so far, most metal is staying inside, which means the system still has room to maneuver. The question is, how much room? And what happens when the next pressure valve gets tested? There's a narrative that keeps circulating in silver discussions. The idea that this is all about investors, about speculators, about traders trying to squeeze the market. That narrative misses the foundation entirely. Silver is not primarily an investment asset anymore. It's an industrial input, and the demand baseline has been quietly tightening for years. Most people focus on the delivery drama, on the COMEX numbers, on the paper versus physical debate, but they're ignoring the fundamental reality that makes all of this possible in the first place. The physical market was already getting tight, long before March became a headline. Solar panel manufacturing is now consuming silver at unprecedented levels. Industry projections for strong years show demand approaching the low hundreds of millions of ounces annually, just from solar alone. This isn't speculative demand. This isn't investment positioning. This is factories buying silver because without it, their production lines stop. And solar is just one sector. Automotive electrification is adding pressure from a completely different direction. Electric vehicles require significantly more silver than traditional combustion engines. Charging infrastructure requires it. Battery management systems require it. Published industry forecasts show automotive-related silver demand climbing toward 100 million ounces per year as EV adoption accelerates globally. Again, this is not discretionary demand. This is manufacturers placing orders because their products cannot function without the material. Add in grid infrastructure upgrades, data centers, 5G networks, consumer electronics, medical equipment. Each sector pulls independently. Each has its own supply chain. Each places orders based on production schedules, not on COMEX delivery calendars. The cumulative effect? A baseline level of industrial consumption that absorbs hundreds of millions of ounces annually, regardless of what's happening in the futures market. Now here's the problem. Silver production doesn't respond quickly to demand signals, and the reason is structural. Roughly 2/3 of global silver production comes as a byproduct of mining other metals, primarily copper, zinc, and lead. What does that mean in practical terms? It means you cannot simply turn on silver production when price spikes. A copper mining company doesn't increase production because silver prices went up 20%. They increase production when copper economics justify it. Silver just comes along for the ride. This creates a fundamental supply constraint that most market analysis completely ignores. When industrial demand increases, there's no immediate supply response. The lag time between price signals and new production coming online is measured in years, not months. Exploration, permitting, development, construction. A new mining project takes 5 to 7 years minimum from discovery to first production. That means the supply available in March 2026 was determined by decisions made in 2019 or 2020. March cannot call new supply into existence. Now some will argue, what about substitution? Can't engineers find alternatives? Yes, and they're trying constantly. Solar manufacturers are working to reduce silver content per panel. Electronics companies are exploring alternative conductive materials. But these are incremental improvements, not wholesale replacements. And more importantly, they take time. Research, testing, retooling production lines, supply chain validation. These adjustments don't happen because a March delivery deadline is getting loud. They happen over years of gradual optimization. The same applies to recycling. Yes, silver can be recovered from industrial applications. Yes, recycling rates are improving. But recycling infrastructure requires investment, collection networks, processing facilities. And recycled silver still needs to meet the same purity standards as newly mined material. Recycling helps, but it's not a magic solution that appears overnight when spot premiums spike. So the reality is this. The physical silver market operates on fundamentally different physics than the paper market. The paper market can expand instantly. Click, click, click. New positions created. The physical market cannot. It moves at the speed of mining equipment, at the speed of refining capacity. at the speed of logistics networks, and right now, those speeds are not fast enough to keep pace with the combined pull of solar, automotive, electronics, and infrastructure demand. Industry surveys from organizations like the Silver Institute have been flagging supply deficits for multiple consecutive years. These are not conspiracy theories. These are published reports based on actual production data and consumption tracking. The market has been drawing down inventories to bridge the gap between supply and demand, which brings us back to the COMEX warehouse situation. The reason registered inventory matters, the reason 100 million ounces feels tight, is because it exists against this backdrop. It's not just about March delivery obligations, it's about a physical market that was already operating with thin buffers before the futures drama even started. When the industrial baseline is absorbing most of the available supply, and investment demand suddenly spikes and delivery requests increase. The system has very little room for error. That's why the eligible to registered conversion question matters so much. The system is counting on those several 100 million ounces of eligible inventory to act as a buffer. But eligible metal is owned, it's spoken for, it's committed to specific purposes. Converting it to registered status means disrupting those commitments, and disruption requires compensation. The market will need to pay through higher premiums, better financing terms, or direct commercial agreements to unlock that buffer. Which means March is not just a test of the futures market mechanics. It's a test of whether the price signal is strong enough to overcome the industrial demand baseline and redirect metal back into the deliverable pool. If the price incentive is sufficient, eligible converts to registered, and March clears. If the incentive is insufficient, if industrial users are willing to pay more than the futures market is offering, then the registered pile stays thin, and the stress moves forward into the next delivery window, with an even tighter baseline underneath it. Everyone wants certainty. Bulls want confirmation that the system will break. Bears want proof that it's all manufactured panic. But markets don't trade in certainties. They trade in probabilities. And the probabilities for March point toward 3 distinct pathways, each with very different implications. Understanding which pathway is most likely requires looking at incentives, not headlines. Scenario 1. The quiet resolution. The market blinks. Not because there's no stress, but because the cost of fighting becomes higher than the cost of cooperating. Margin requirements stay elevated. Holding positions into delivery becomes expensive enough that most leverage players choose to roll forward rather than stand. The open interest that looked threatening in early February, it shrinks as participants exit or defer their claims to later months. Industrial users, the ones who genuinely need physical delivery, negotiate private arrangements. They get their metal through bilateral deals that happen off exchange. The COMEX warehouse numbers show some movement, a modest amount of eligible converts to registered. Enough to meet the remaining delivery requests. March clears. The headlines declare victory. See? No crisis. Everything worked fine. But beneath the surface, the registered pile remains thin. The buffer stays depleted. And the system rolls into the next major delivery window, May or July, carrying the same underlying tension forward. This is the outcome the exchange prefers, not because it solves anything, but because it buys time. Scenario 2. Inventory choreography. The system responds, but the response is visible. Eligible metal begins converting to registered and meaningful volume. Not a trickle, a flow. Warehouse reports show bars being retagged, ownership changing hands within the approved vault network. To the casual observer, it looks like chaos, movement everywhere, numbers fluctuating daily. But to those who understand the mechanics, it's plumbing. The system is tapping its buffers, using the eligible inventory exactly as it was designed to be used, as a pressure release valve. March deliveries happen, metal changes hands, the obligations get settled. But the cost is transparency. Everyone can now see how thin the registered layer actually was. Everyone can see that eligible metal had to be mobilized to meet demand. And that visibility creates a new problem. Next time, fewer people will trust that the buffer exists. Fewer holders will be willing to convert their eligible metal without demanding even higher premiums. The system survives March, but the precedent weakens confidence for the future. Scenario 3. The physical withdrawal. This is the pathway that keeps clearing houses awake at night. A cluster of large holders, industrial users, sovereign entities, institutions with storage capacity, decide they don't want warehouse receipts. They want metal out, physical bars, loaded onto trucks, removed from the COMEX-approved vault network entirely, not as a financial trade, as a statement. We no longer trust this system to deliver when we need it, so we're taking custody now. If that happens at scale, if withdrawal requests exceed what the logistics network can handle in the available time frame, the system faces a genuine scramble. Spreads invert sharply, the nearby month trades at massive premiums to deferred months, financing costs spike. The exchange responds with emergency measures, rule modifications, settlement alternatives, possibly cash settlement options for contracts that cannot be physically delivered. And this is where most collapse enthusiasts get it wrong. They imagine the system admitting defeat, declaring default, handing victory to those who saw it coming. That's not how systems work. Systems protect themselves. When stress becomes unmanageable, rules change. Trading gets restricted. Settlement terms get modified. The participants who thought they were going to win discover that the rulebook was never written in their favor. The people who run the clearinghouse, the exchange, the regulatory framework, their primary obligation is to the system's survival, not to fairness, not to market purity, to survival. So even in the worst case scenario, the outcomes is not a clean victory for physical holders. It's a messy, contentious process where costs get redistributed, obligations get renegotiated, and everyone learns that challenging the settlement infrastructure comes with consequences. What actually gets monitored? Professional participants are not watching price charts right now. They're watching conversion rates. How fast is eligible becoming registered? They're watching margin trajectories. Are requirements still climbing or stabilizing? They're watching spreads. Is the front month staying bid relative to later contracts? They're watching withdrawal data. Is metal leaving the vault system or just changing owners? And most importantly, they're watching physical premiums in the cash market. If premiums in Dubai, Singapore, or Zurich stay elevated even when COMEX paper prices drop, that's the signal. It means the physical constraint is real. It means price discovery has fractured between paper and physical layers. It means the arbitrage that's supposed to keep these markets aligned has broken. That's the indicator that matters more than any delivery report, because it tells you where the genuine scarcity lives. March will be volatile. That much is certain. Prices will swing, headlines will scream, both bulls and bears will claim vindication at various points. But the real outcome won't be determined by who yells loudest. It will be determined by whether the system's pressure valves, margins, conversion incentives, financing mechanisms, can manage the stress without breaking settlement trust. And if trust holds, the machine keeps running, not smoothly, not without cost, but it keeps running. Because that's what systems are designed to do. Stretch, absorb, adapt, survive, even when the math says they shouldn't.